Inflation is unacceptably high. We need to do everything we can to bring it down. It was heartening to see headline inflation tick down modestly last month, but obviously we've got a ways more to go.
Inflation is biting. We see for low income or lower income families really difficult to deal with the rising cost of energy.
I think we're going to have a second big bite at this apple, a recession that's more traditional in sense, where the Fed can't bail out the recession because they're still tightening to control inflation.
This is Bloomberg Surveillance, early edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Prepared for pain, Jay Powell gives his most hawkish speech yet, saying he's ready to raise rates past neutral to tame inflation. UK inflation, in fact, rises to its highest level in 40 years, adding to pressure for action from the government and the BOE. We get data from the Eurozone a little bit later today. Plus, Jamie Dimon rebuked a rare blow for the Wall Street titan as a non-binding vote rejects the JPMorgan's chief executive's compensation plan. Now, first thing is first, because we have a plethora of story that we need to get through, but this is what the market's looking at. We started the note on the high. Now we're seeing a bit of pressure, down some 0.2%. Again, when you look at what markets are thinking at, well, I guess some of the stocks are actually falling. They did not build on the rally we saw yesterday. We did have, of course, those hawkish comments from the Federal Reserve Chair, but also the latest data on inflation and economic activity. It's what traders will probably latch onto. The FTSE flat, the dollar index, and I had a couple of calls, so it's good to look at the Bloomberg US dollar index, but also could we be looking at parity between euro and dollar? That's probably one of the biggest questions we need to ask ourselves in the next couple of weeks, and this is especially if the ECB can always raise rates to the point where markets are pricing in, and you can see pound or cable at 123.96. Now, in terms of the difference between, for example, Germany, and we're seeing factory orders and we're seeing the German economy, if we get the European map up for you, when you look at this economy, which is Germany, it will have, of course, a huge impact on everything that's going on in Russia. It's probably the economy that will suffer the most because of the reliance on energy, because of the proximity to Russia. In today's trading session, you can see the FTSE MIB and the FTSE here in the UK unchanged, the CAC down 0.1%, similar to the DAX. But you're seeing, I don't know if it's volatility, but certainly they haven't really made up their mind of whether they're focusing on the positives or the negatives. Now, Jay Powell has said the Fed will not hesitate to raise rates above neutral and warned that it may bring discomfort. We've also been hearing a hawkish tone from some regional Fed presidents.
Inflation is coming down. That's what we really need to see. So we'll be watching for that. If that involves moving past, broadly understood levels of neutral, we won't hesitate at all to do that. We won't.
I have been concerned that we need to take aggressive action to keep inflation under control. But right now, I think we have a good plan.
What a lot of economists are scratching their heads and wondering about is if we really have to bring demand down to get inflation in check, is that going to put the economy into recession? And we don't know. At least I'll speak for myself. I don't know.
Well, joining us now is Bloomberg's managing editor for EMEA markets coverage, Lynn Thomason. Lynn, when you look at some of this inflation debate and how the market is positioned, what's the next step for where markets get their cue on?
Yeah, I think everything is so keying on the inflation data. And the really interesting thing is that hot number from the UK this morning really shows that it's just continuing to get worse and worse. And where you're seeing the US and EU expectations are for inflation to soften, the UK looking like it's in a really difficult spot.
And so what does that mean so when you look at markets and actually how equities are performing, is worse, or actually is recession already priced in, or do you think it has a lot more to fall?
That's such a good question. I mean, global stock market's already down, to the tune of 16% this year. So it sure seems like people are, at least getting ready for that recession. Big question will be, how bad does the recession look? I mean, if it really is a stagflation situation, I think a lot of people would say we're not pricing in that scenario. If anything, we're, looking like a sort of a mild recession at the moment.
So, Lynn, what's risk appetite like? And I know it changes every day, and sometimes it changes even though the facts don't really change.
Yeah, I mean, the interesting thing last week was you had that incredibly severe sell-off, and then the mood has softened this week. Markets are mixed, things are starting to stabilize. I mean, what's really interesting is that for all the, terror in the crypto world last week, things are stabilizing, and Bitcoin is really holding at that 30,000 level, which shows that, perhaps people are finding some reason to stick to that.
Lynn, when you look at the dollar, I mean, it's ever higher. I don't know if there's anything to stop that rally.
Yeah, I mean, we had a great story today about the speculation that there might be some kind of coordinated intervention to bring down the dollar. I mean, obviously, very speculative. Who knows what's going to happen? But even the fact that that's starting to be talked about in the market just goes to show how worried traders are about the strength of the dollar and what that means for economies and, the purchasing power of people around the world.
I mean, this changes everything, right? There's almost no sector that's immune to a rising dollar.
Yeah, absolutely. It'll play into companies' balance sheets. Obviously, companies that import or, sort of get their sales in dollar will be doing well, and you might start to see that differentiation in the stock market. But I think there's a lot of concern that the dollar strength is just going to be disorderly, and you rarely do you see such strong moves happen so quickly.
Lynn, anything else you're looking for? I mean, I know it's inflation. We're looking at the specter of recession. We're not looking at earnings anymore, and then we're seeing it seems to be playing out on currency markets, really.
Yeah, absolutely. I mean, for the longest time we thought currency volatility was dead, and now it has come back with a vengeance. Yes. I mean, the stock market is usually where you go to see volatility, but now it's in currencies, and really the dollar is such a dominant force around the world.
Yeah, and I have to say, when currencies are volatile, they don't kid around. So thank you so much, Lynn Thomas,
Thank you.
there, joining us with the latest on the markets. Now, coming up, our exclusive conversation with Andrea Orcel, the Chief Executive of Unicredit. We talk Europe's inflation situation. That's coming up shortly, and this is Bloomberg.
When I look at Russia, separating it, there are two orders of effects that we look at. One is the direct shock from our exposure to Russia. I think that in the last 2 months, we have achieved to reduce it meaningfully by about 2 billion. We've done that. Actually, the team has done a great job without that costing the bank almost anything, which was not to be expected. And at the same time, we have understood very well and in a granular way what the risks are. And we think that in Q1, we took a very conservative set of provisions to try and insulate ourselves the most possible from the further effect from a degeneration of that situation.
The provisions were quite large, and the market took it quite well. Is that how you would describe it?
I think so. I think what we did is, during those 2 months, we were able to articulate in a detailed way what is our extreme loss scenario for Russia, converted in numbers on hit on capital, it's about 130 basis points of capital. And in the first quarter, we took about 195 to be exact.
The question is now what you do with this unit. Are you frustrated that you keep on getting asked over and over what will happen to Russia and the employees there?
Well, I think that anyone who has a large presence in Russia or a significant presence in Russia is being asked. It's normal. I think we believe strongly that let us show you what we execute, and let's talk about it then. Because at this point in time, while we have reviewed the situation, we have a number of options that we could pursue. The options are very much affected by the next wave of sanction, by who are the counterparts, what we can do, what we cannot do. And at the same time, we should not forget that we do have 4,000 employees in Russia. We do have 1,500 corporate clients. And what people sometimes forget is that 1,250 are actually Europeans who are trying to go through the same thing that we're going through as a bank, which is deal with the situation in the best way possible.
Well, the Unicredit Chief Executive, Andrea Orcel, there speaking to me. You can catch more of that exclusive interview on your Bloomberg terminal. It's about 40 minutes. And then you can also catch it on TV tomorrow, 6:30 p.m. UK time for the full 30-minute program. Now let's get the latest on the Twitter takeover. In spite of Elon Musk's ad hoc tweets and conference statements creating noise and uncertainty around his bid to take the company private, behind-the-scenes advisors are working to seal the transaction. Well, for more, we're joined by Bloomberg's Laura Wright. So, Laura, what do we know? Is he going to buy it? Does he want to buy it? Does he want to buy it cheaper, or is he just going to walk out?
Well, yesterday, Twitter released a statement to Bloomberg News that said, "We intend to close the transaction." Twitter trading negatively in the pre-market, although yesterday the social media platform was able to snap 7 straight sessions of losses. So we learned from an SEC filing yesterday that Elon Musk waived his rights to due diligence so that it could expedite his bid before an arbitrary April the 20th deadline. We know there's a $1 billion exit fee for either party that walks away. There is also a specific performance clause, which means so long as Elon Musk has the financing in place, he is obligated to go ahead with the offer, unless he can prove something has materially changed. And that is what Elon Musk is trying to do by rallying support, challenging Twitter's statement that less than 5% of their users are false accounts. Just last night, he posted a Twitter poll on this. It currently has around 1.5 million votes. But Francine, it's a lot of chaos, a lot of confusion. Which way Elon Musk wants to take this?
Yeah, I mean, certainly he's like one-man band, driving this. What do we know regarding SpaceX financing rumors?
Well, coincidentally or strategically, you might argue, there are reports that SpaceX will be going ahead with a new funding round that should value the satellite company at close to $125 billion. That means SpaceX will be the most valuable U.S. startup on record. Employees will be able to offer their shares at close to $70 in a tender. It's unclear yet whether Elon Musk will partake in such a sale. One of the reasons why he might do this is so it can eradicate a $6.25 billion margin loan, which is still tied to his Tesla shares and has been rather contentious. Although that said, eyes are now focused on this $13 billion debt tied to the social media platform, because as part of the deal, that means there'll be annual interest payments of around $1 billion. While Elon Musk hasn't outlined just how he's going to diversify Twitter's revenue strategy, for analysts, that's looking like a bit of a financial headache.
Yeah, it certainly is. Thank you so much, Bloomberg's Laura Wright, with the very latest on Twitter. Now, coming up, the U.S. overtook China as the top destination for Swiss watch exports in 2021. We'll be joined by the chief executive of Watches of Switzerland, Brian Duffy, to discuss earnings results and growth in the U.S. market. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gehrens. Hi, Leanne.
Hi, Francine. UK inflation has risen to its highest level since Margaret Thatcher was Prime Minister more than 40 years ago. Consumer prices surged 9% in the year to April, the fastest rate since 1982, and more than double the pace of basic wage growth. The Bank of England is predicting double-digit inflation by October, when energy bills are likely to jump again. Now, Chair Jay Powell says the Fed will keep raising interest rates until it sees clear evidence that inflation is actually cooling. Powell made his most hawkish remarks yet at a Wall Street Journal event, saying he won't hesitate to push rates past neutral if needed. Powell repeatedly stressed that price stability is the Fed's top priority.
Inflation is coming down. That's what we really need to see. So we'll be watching for that. If that involves moving past, broadly understood levels of neutral, we won't hesitate at all to do that. We won't. And honestly, we will go until we feel like we're at a place where we can say, yes, financial conditions are in an appropriate place. We see inflation coming down.
Now, the US is preparing a military aid package for India that looks to deepen security ties and reduce New Delhi's dependence on Russian arms. Bloomberg sources say the package could include weapons financing of as much as $500 million. That would make India one of the largest recipients of US military aid, behind both Israel and Egypt. And the Wall Street Journal is reporting that black box data from a China Eastern Airlines jet that crashed earlier this year suggests someone in the cockpit intentionally sent the plane into its fatal descent. The Boeing 737-800 jetliner was cruising at high altitude when it suddenly nosedived at high speed into a mountain, killing everybody on board. JPMorgan shareholders have rejected a pay proposal for the top executive, dealing a rare blow to CEO Jamie Dimon. Just 31% of voters supported the package for Dimon and other company leaders. Shareholders, advisors, Glass Lewis were among those criticizing a $53 million option award for Dimon. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, Watches of Switzerland saw revenue growth of 48% in its fourth quarter earnings, with continued super high demand for brands such as Rolex and Patek Philippe. Now, the UK-listed company has been expanding aggressively in the US, now the most lucrative market for luxury watchmakers and sellers. Well, we're joined now by the chief executive, Brian Duffy. Brian, thank you so much for joining. I remember actually our first interview, which was, I think, the day you listed. And that feels like yesterday,
yeah,
but it was
3 years ago.
Pre-pandemic.
Yep.
Talk to me a little bit, first of all, how you've lived through the pandemic. So there's no travel. I guess, I don't know whether people bought watches online or whether that was just too difficult.
Yeah, I mean, a variety of things. There was a big increase online. We doubled our business online. Our US business had less of a lockdown than the UK. UK, we were able to do click and collect. We really used our systems. We get great CRM systems. We get great technology all around. So we were able to keep a reasonable business going. So even in the first year, we still had growth, 5%, despite the lockdown, despite the fact there was no tourists, despite the fact there was nobody in the airport. Next year, 11%, and then this year, 40%. So we've done okay.
Brian, you know, given where we are now, almost to June 2022, what surprised you the most about the business? Is it the resilience? Is it the fact that now you have more, appetite for your products in the US and elsewhere?
Yeah, it's not a complete surprise to us. I mean, our view has always been the market's underdeveloped. The UK is the best luxury watch market in the world, but even here, I think we're proving that it's underdeveloped. And the US, for sure, was underdeveloped. So we already were enjoying a really good experience in the US from investing, bringing our formula for beautiful big stores and luxury client service. I think, during the COVID period, did this category get a bigger share of wallet because people couldn't travel and so on, perhaps. So perhaps there was an element of acceleration. And what surprises me continually is just how innovative and energetic and enthusiastic our people are.
Do you miss Chinese tourists, of course, in destinations where you have shops?
It was never a big deal for us. I mean, it was 7% of our group beforehand was Chinese tourists. The airport was a bigger loss overall for us, just people travelling through the airport. So fiscal year 19, pre-COVID, 33% of our business was international airport or combined tourism. The last year it was 3%, so we had to overcome a deficit of 30, before growing. But we love our watches here and in the US, and there's more demand than we can supply.
Is there more demand so people don't go for the new cool ones that give you how many steps you do and things like that?
You mean ones like this one, the tag connected? People do. Obviously people are wearing Apple watches around the world, but there's been no impact in the world of luxury watches.
What are you wearing? This is a fancy...
This is a Tag Heuer connected watch. The LVMH group have done a lot with technology on connected. This does tell me my steps.
Do you sell more of those as opposed to like the old school ones?
No.
Do you think you will in the future?
I mean, old school, as you call them, traditional, mechanical, artisanal. There's a huge demand for mechanical watches, and as I said, one that we're nowhere near to supplying. I think this is nice new technology, and in this case, it's put in a beautiful case, with a nice strap, and it's a reasonably expensive watch. You're still looking at £2,000. So I mean, it's all positive.
So what does it do? I feel like, I mean, it's lighting up. You're talking, it's lighting up.
But it's doing pretty much everything an Apple Watch would do. It's telling me my steps. That is why I have it. You know, it was never practical to personally count.
You can wave Italian hands like I do, and you get steps without actually moving.
Oh yeah,
right?
Okay, you're cheating. But you know what? I play guitar, and I have to take it off because I get step credit for playing guitar. Yeah.
Brian, talking about inflation, are you able to? I mean, I imagine that your customers are not inflation sensitive, so you can hike prices by even 30% without hurting demand.
But that's not happening. I mean, I think the industry's been very considerate. The average price increase this year will be around between 4 and 5%. And commodity prices have definitely increased more than that. The Swiss franc has appreciated, particularly against the pound. So I think the industry's been quite thoughtful and not pushing pricing overall.
But why not when you see, you know, companies such as Chanel going up 25%?
Yeah, I mean, we don't determine the pricing. Right. It's determined by Rolex and Swatch Group and Richemont and so on. And as I say, I think they've been considerate in you know, what's happening in the world. But whatever, the average increase is around 4 or 5% for the year.
So what's, you know, happening with you in the next 12 months? Is there expansion plans? Is there anything exciting that you?
Yeah.
That's secret that you can tell us about?
Well, a formula I think is proven. We have a great model. We proved it in the UK. We've now proven it in the US. We did a long-range plan saying we'd increase our US business between 25 and 30% annually. Obviously, that we're ahead of that this year, quite comfortably with a 48% increase this year. Yeah. We're entering the European market. We have a lot ahead of us.
Brian, thank you so much. Brian Duffy there, the Chief Executive of Watches of Switzerland. Coming up, a conversation with Mohamed El-Erian. This is Bloomberg. Prepared for pain, Jay Powell gives his most hawkish speech yet, saying he's ready to raise rates past neutral to tame inflation. UK inflation rises to its highest level in 40 years, adding to pressure for action from the government and the BOE. We get data from the Eurozone later today. Plus, Jamie Dimon rebuked a rare blow for the Wall Street titan, and his non-binding vote rejects JPMorgan Chief Executive's compensation plan. Well, good morning and welcome to Bloomberg Surveillance Early Edition, everyone. I'm Francine Lacqua here in London. Now, this is what the markets are telling us. There was a bit of volatility across the board. We started the day higher. Now we're seeing a bit more pressure. The European stocks, 600 down 0.1%. So some of these stocks are stalling. Certainly, they're not building on yesterday's rally as traders assessing those hawkish comments from the Federal Reserve Chair, but also the latest data on inflation and economic activity. Now, Andrea Orcel is leading Unicredit through a war in Ukraine, rampant inflation and aggressive central bank tightening. In his first TV interview since taking the helm of the Italian lender, Orcel spoke to us exclusively about his botched hiring at Santander, as well as Unicredit's Russia exposure.
I will always be sorry for how it went. This is another bank I admire a lot, and that hasn't changed. I think for me, it was more about confirming the facts, confirming the truths that I knew existed, and that has been done, and it's uncontroversial. I mean, you will find it black over white through the process that has happened. That for me was very important because a number of stories were written at the time. What happens then, I mean, obviously Santander has appealed, we'll see, but for me the important point was that the truth is there, the facts are there, and at least mentally I have moved on.
I mean, your case is probably studied in universities, because people want to know how they're paid. You know, I think 68 million without never starting a job, but also to try and understand what labor laws and everything like that works. Do you think it's changed the way we look at banking laws and banking?
I don't know if it has changed. What I know is that we shouldn't forget that banking is a highly regulated industry. As a result of that, senior jobs have a very large component of deferral in their compensation. In the UK, it's 7 years. And more than 50%, if not 60 in certain cases, of your compensation is deferred over 7 years. If you do the math, that means that at every point in time, you're going to have between 3-4x of your compensation deferred. And that is indexed to the share price of the bank where you are, and if it goes up, those 3-4x becomes even more. The difficulty is when you change organizations, what do? You either have a new organization that assumes that deferral, or you don't move. Because in effect, that deferral is your entire savings. So I do think that although these are large numbers, they need to be put in context of how they got there. Usually, in most cases, in all cases, the organization who hires assumes that liability or deferral. So that number is that liability and deferral, is plus a few other things that occurred because of the case, but that is what it is.
Was it an emotional roller coaster? Is it something that you've put behind, or is something that you don't think about?
Well, at the beginning, it was obviously an emotional roller coaster. I think from a family standpoint, it was quite impactful, and I think personally, given the esteem I had for that bank, it was quite impactful. I think the important point was once I went through the preparation of the case, I detached and I left other people deal with it, and I was quite fortunate that those people were excellent. And then I trusted the process. A lot of people told me not to trust the process, but I did, and it ended up being worthwhile.
That was Unicredit Chief Executive Andrea Orcel speaking to us exclusively, and you can watch more of that conversation on your Bloomberg terminal and online. Now, we're also getting some earnings from Tencent. First quarter revenue just shy of estimates at 135 billion yuan. I think the figures we had speaking to analysts was 141 expected. Now, let's get back to banking. JPMorgan shareholders have rejected a pay proposal for top executives, dealing a rare defeat to the chief executive, Jamie Dimon. Just 31% of voters support the pay packages for Dimon and other company leaders. Now, joining us next is Bloomberg's finance editor, Michael Moore. Michael, thank you so much for joining us. First of all, I can't see Jamie Dimon taking this very well, but why was the pay rejected?
Well, I think a lot of it was had to do with the special awards that were awarded last summer. That was supposed to incentivize Dimon to stick around several more years, as he has been in place for a long time. So I think that was kind of the main piece, and then also the pay has steadily risen. So I think this is shareholders sending message, but obviously it's non-binding proposal. So the bank doesn't have to walk it back, but you tend to see banks make some adjustment, at least in future years, to take this on board when they do get this kind of rejection.
So what's the wider significance of this?
I mean, it's pretty rare. You had Citigroup a decade ago have this happen, and it became a major issue for them. They had to address it in future years, but so these say on pay proposals only came in after the crisis. Typically, you see 80+% in favor. So I think this is pretty rare. It may, you may see the bank try to make more of it tied to specific performance metrics. Banks have been moving in that direction generally, but because the bank has done quite well, Jamie's awards have grown over the years. Even the ones he was given at the time ended up being worth a lot more than the stated value at the start. So I think as long as the bank continues to perform this well, it won't be as big an issue.
Mike, the other big story is, of course, the big change at Société Générale after the chief executive said he'll step down next year. Yeah,
he's the longest-serving European bank head.
15 years or 13?
Yeah, it will be 15 by the time he steps down next year. He's went from everything from financial crisis then to the crisis in Russia and Ukraine now. So he's seen quite a bit in what has been a very turbulent period for his bank and European banks in general.
All right, Michael, thank you so much. Michael Moore there, who heads our finance coverage in Europe. Now, coming up, we speak to the Bloomberg opinion contributor, the one and only Allianz Chief Economic Advisor on the Fed stagflation, the outlook for the U.S. economy. He's one Mohammed El-Arian. If you have any questions for him, send them to IB Plus TV Go. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Jay Powell said that the Fed will not hesitate to raise rates above neutral. In an event hosted by the Wall Street Journal, he called price stability the bedrock of the economy and vowed to push until inflation falls.
If the economy performs about as we expect, then that's something that'll be on the table. And honestly, so things are so uncertain in the economy right now, it's very difficult to think about trying to give guidance out into the future.
Well, we're now joined by Mohamed El-Erian, Allianz Chief Economic Advisor, President of Queen's College, Cambridge, and Bloomberg opinion columnist. Mohamed, great pleasure and honor actually to have you in the studio.
Thanks
in
for having
London.
me.
You've been banging the drum about the Fed being too late. Is a recession at this point now unavoidable in the U.S.?
It is not unavoidable, but unfortunately the probability is going up. What is unavoidable is stagflation. And we're seeing growth coming down and we're seeing inflation remaining high. And the Fed is finally catching up to developments on the ground, but it still has some way to go.
Okay, so if you look at stagflation, what does that mean for stocks? How much of it is already priced in, or how much more volatility will we get?
So we've gone sequentially through pricing in inflation risk and interest rate risk to pricing in tighter liquidity. What we haven't priced in yet is a significant slowdown in growth. So we are mostly through the adjustment, but not quite there yet. I think there's probably another leg to come.
Mohamed, what does this mean for the U.S. consumer? Are they strong enough to withstand this for a couple of quarters?
So the consumer in general they still have significant savings that were built up during the pandemic with all the transfers from the fiscal side. But the issue, Francine, is distribution. There are very vulnerable segments of the population, and so far we haven't seen enough being done to protect them.
Now, stagflation is also, I guess, every central bank's worst nightmare. When you look at the situation in Japan, I mean, they were stuck in this for a long time. Is the U.S. or the world becoming more like Japan, or is it a stagflation, a transitory stagflation environment?
So that is really hard to project at this time. Stagflation is the worst thing for central banks, especially for the Fed, because it puts its two objectives in conflict with each other. And that's why a lot of us wanted to avoid the situation. And this situation was avoidable. That's what sort of upsets a lot of us. It was avoidable had the Fed not stuck to its transitory inflation characterization. Now that we're here, it is very hard to find a first best policy outcome. So the Fed is going to have to make a very difficult choice. A lot of people say it needs luck and skill. Well, it needs a lot of luck at this point.
So what would you do if you're in charge of the Fed right now?
So what I would do is I would first and foremost explain why I got the inflation call right, because I need to restore my credibility on inflation. I would explain how I am better as a Fed in forecasting inflation, and I would take actually the approach of Andrew Bailey at the Bank of England. I would be brutally honest. Technocrats should be brutally honest, and I think Andrew Bailey is showing the example to other central bankers of what does it mean to be a technocrat. Yeah,
but it doesn't make the job any easier if you're in this kind of environment. So does the Fed need to go 75 basis points? Where do you see the terminal rate, for example?
So all this discussion of the neutral rate forgets that ex ante, we don't know what the neutral rate is.
Fair.
So they're going to have to go and get a sense, and they better go early than late. Already we are late in reacting. So they're going to have to judge as they go along, but they're going to have to start. If it were up to me, I would start with 75 basis points. I wouldn't start with 50. I would give a very clear signal that I'm serious about this, and I would try to contain inflation expectations from now.
But they took it off the table, and I don't know whether that was to guide the markets. Are they concerned about market reaction? Like, what exactly is this dynamic?
So I think Chair Powell took it off the table.
Yeah.
He was then pressured by the market immediately. He was then criticized by many people saying, how could you take it off the table? If you say the economy is so uncertain, how could you take... And if you've noticed, he walked it back. And yesterday, he took one step further back in walking it back and saying, you know what, I will be open. And he's also taken back the notion that he knows what the neutral rate is. He's now willing to say, I may have to go beyond the neutral rate. So he is evolving because of the reaction to when he tried to be too specific in a very uncertain environment.
When you look, of course, at this reaction function between markets and the Fed, at what low point in the S&P does the Fed put start to kick in?
So I don't think it kicks in for a while. It kicked in the past because inflation wasn't a problem, right? Ben Bernanke had an interview, and he said the reason why the Fed didn't move earlier was because of concerns for the markets. Yeah. Well, now it is inflation. So I think those who think that the Fed put this anywhere in the money will be sorely disappointed. It's quite out of the money right now.
So is a dollar rally then unstoppable? I know that there's also chatter about intervention. I mean, things that we haven't heard, frankly, for almost a decade.
Yes, I mean, Bloomberg is running a story today that the unthinkable of another Plaza Accord is now being talked about. I think that remains unthinkable. I think right now, the international environment doesn't allow for a currency accord. Having said that, the strengthening dollar raises the specter of what I call little fires everywhere. Because if you're in a developing country right now, the last thing you need is a disorderly depreciation of your currency against the dollar at a time when energy prices are higher, food prices are higher, and the global economy is slowing down.
Okay, little fires. The problem is that if we have one big one, that all matches up. So we'll talk about that next. Mohamed El-Erian there stays with us. Now, let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Francine. A unit of Allianz has pleaded guilty to fraud and has agreed to pay $5.8 billion after misrepresenting the risk posed by a group of hedge funds that collapsed during the pandemic. The deal closes an embarrassing episode from the German insurance giant, which has also agreed to sell the bulk of Allianz Global Investors US as part of a settlement with the SEC. Walmart shares have tumbled the most in almost 35 years after it cut its full-year profit forecast due to inflationary pressures, especially in both food and fuel. The world's largest retailer set the stage for more price increases, saying it would seek to balance customers' needs with the goal of delivering profit growth. SocGen CEO Frédéric Oudéa says he will leave the bank next year after nearly 15 years. The longest-serving CEO of a big European lender has told shareholders of his surprise decision not to seek reappointment during the company's AGM. SocGen says it will select a new CEO by next year. And Saudi Aramco is said to be considering an IPO for its trading arm in what could be one of the world's biggest listings this year. Bloomberg has learned the state-controlled oil giant is working with banks including Goldman Sachs, JPMorgan and Morgan Stanley as it studies a potential listing. The business could be worth as much as $30 billion. And that's your Bloomberg Business Flash. Francine.
Leanne, thanks so much. Coming up, Allianz Chief Economic Advisor and Bloomberg Opinion columnist Mohamed El-Erian on that hot UK inflation reading. We'll talk sterling. We'll also talk a little bit of ECB. That and much more next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now we're back with Mohamed El-Erian, Allianz Chief Economic Advisor, also Bloomberg Opinion writer. And I have to say, everybody should subscribe to Mohamed's columns because they're great, they're brilliant, and sometimes they're also very funny. Mohamed, thank you so much for staying with us. We were talking, about what the Fed's mistakes have been, and you were saying, look, they just have to be much more honest, like Andrew Bailey. So we'll talk about the Bank of England in a second. But talking about this idea that actually what we're creating with the dollar rally is fires, right, across the globe. Is there a worry that these fires suddenly join up and actually the whole forest is on fire?
Yes, there is. I mean, right now we're focusing on the big fire, which is, of course, the Ukraine war. Yeah. But that big fire has triggered small fires because of what it's done to food and energy prices. Add that to the dollar appreciation, and we are going to see, unfortunately, quite a few commodity imported developing countries coming under pressure. What does that mean? Lower growth. Yeah. It means debt restructurings. Yeah. And it also means, unfortunately, socio-political instability.
Does it mean defaults?
So I do think you're going to get restructurings. Whether it means outright defaults will depend on the international organizations. There's a lot of work being done by the IMF and the World Bank to give air cover to orderly restructurings, and it's in everybody's interest to have orderly restructurings. But I suspect that we will see a lot of original contracts being modified.
Could there be something big enough that actually puts the whole system, financial system, at risk? I mean, if we're able to freeze out the 11th biggest economy in the world, Russia, and suffer consequences, but more linked to the gas and oil, does it tell you about the resilience of the world economy, or is it something else? So
it's certainly resilient, but we are running down our resilience tank. Don't forget that we ran quite a bit of it down in COVID. So, for example, we cannot respond on monetary policy like we responded during COVID. We cannot respond on fiscal. So we are running it down. We still are very resilient. I worry less about the advanced economies than I do about developing countries. And I think the comment in particular by the IMF Managing Director, Christina Georgieva, which you know very well, which is we could be talking about a cost of living crisis in the advanced world, but we risk a famine in the developing world. I mean, that is the difference right now.
So again, what does that mean? I mean, is there any organization that can step up? Because what you say is very true, and it's largely ignored by a lot of big economists.
It is. I mean, a lot of people were hoping that at the spring meetings of the IMF and the World Bank, that there would be some sort of multilateral reaction. Unfortunately, we couldn't even get a communique out of the G20, so it didn't happen. So we've got to get moving on this issue. I mean, there are lives involved here. This is not just livelihoods. This is lives.
But no Plaza Accord, nothing that would actually help anyone coming together.
Not in this environment.
Why not? Because everyone's looking after themselves?
They're looking after themselves. The amount of multilateral coordination is quite low. Yeah. You have tensions between the US and China, right? So it is hard to get everybody in a room and to agree. Remember, they couldn't come up with a communique. And you and I know that these communiques tend to be wishy-washy. But if you can't, so multilateral coordination is a challenge right now.
Yes, the benchmark is pretty low. You're right, if you can't even get a communique out. All right, talk to me about the idea, which fascinates me, that Andrew Bailey, that frankly has come under a lot of flack here in the UK for being so candid, asking also employees not to ask for raises because that would make his life easier in dealing with inflation. The fact that you admire that actually he's so upfront and sometimes saying, well, look, we messed up, but I'm not really sure where we are in 3 months from now.
Yeah, and I think it's his brutal honesty that has taken people by surprise outside the economic profession. But within the economic profession, it's admired. The role of a technocrat is to express opinions as they see it and not to be politically influenced. Because if technocrats are politically influenced, then no one expresses opinions as they see it.
But it doesn't make his job any easier. I mean, this is a small, open economy. Inflation's higher almost than anywhere in the world. And actually, it's extremely difficult to see what he does with interest rates.
Right. And it certainly makes his job a lot harder. But remember, he's dealing with an inflation rate that is also being impacted by delayed price adjustments. The gas price adjustments that kicked in April are delayed. That should have happened last year. And now it's coming on top of everything else. So yes, he's dealing with a high inflation rate. But again, look at the Bank of England. They moved first in acknowledging that inflation isn't transitory. Yeah. They moved first in hiking rates among the major central banks. And they've moved first in being brutally honest. I think actually that they continue to set an example for other central banks.
Okay, in 30 seconds, the ECB, I mean, that seems like also another nightmare. Can they really hike as much as the market thinks they will?
That's the hardest policy challenge right now. I would not like to be in Madame Lagarde's position.
Me neither. Well, thank you so much, Mohamed Nalarian there, Chief Economic Advisor, President of Queen's College, Cambridge, and Bloomberg opinion columnist. I could speak to you for another 3 hours, so you have to come back, Mohamed. Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller, Kailey Leinz in New York, Anna Edwards here in London, and this is Bloomberg.
There's just a lot of pessimism in the market, more than we've seen in years.
People are looking at the glass as being half empty. There are a lot of half full notions out there as well.
What we're shifting to now is a market that is going to be dominated and is being dominated by the growth impact of that central bank shift.
Don't fight the Fed is definitely the mantra in the bond market, and the Fed seems to be on a very hawkish course to continue to hike rates.
The risk case is that they have to do more, and that then also raises the risk of a hard landing.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Wednesday, April 18th. Our top stories today. Jerome Powell's most hawkish tone yet. The Fed chair vows to keep raising interest rates until inflation is in retreat. UK inflation hits a 40-year high. Consumer prices soar 9%, putting pressure on the government and the Bank of England to take action. And Sweden and Finland make it official. They've now formally applied for membership of NATO, but they still have to overcome opposition from Turkey's President Erdogan. Welcome to Bloomberg Surveillance Early Edition, everybody. I'm Anna Edwards in London with Kailey Leinz and Kriti Gupta in New York. Matt Miller is off today. And Kailey, European equity markets stalling a little bit, risk appetite stalling a little bit globally.
Yeah, that wasn't necessarily true in Asia overnight, where you actually had most stocks higher on the day, following on from the gains we saw in the U.S. yesterday. The MSCI Asia Pacific Index actually higher for the fourth day in a row, which is the longest winning streak going back to early February, a gain of about 0.8%. Now, there was one market in particular that sat that out, and that was the CSI 300 in China, but you had stocks higher in Japan and in Hong Kong, where they were up about 0.9% and 0.2%, respectively. Now, of course, what's interesting is you had Le He, the chief economic chief in China, meeting with big tech companies yesterday, talking about support for companies in the digital economy and their overseas listing. The question is whether or not investors really buy the idea that China is going to do that, and what difference will it really make in an economy that is slowing in the face of COVID-0. We saw that reflected in Tencent's results, which came out after the Asian close, showed the slowest revenue growth since the company went public back in 2004, came up short of expectations, showing the impact of the technology crackdown and the slowdown in China. Finally, I would point out that in foreign exchange, the Japanese yen is the outperformer in Asia as well as in G10. It's actually the only G10 currency stronger against the dollar this morning, stronger by about 0.1%. We're trading right around 129.23, Kriti.
Yeah, Kailey, if we're looking at green on the screen in Asia, we're actually seeing the exact opposite in future trading for the S&P 500, down about, it looks like about 0.4%. And this is important because it comes on the back of that 2% rally yesterday. So is this a true risk-off feeling, or is this simply kind of paring back some of the monstrous gains we saw yesterday? But remember, we also look at the cross-asset picture. The 10-year yield is down about 2 basis points. It's not that much of a move, just given the volatility we've seen in the last couple of weeks and months. But still, to see a bid lower into yield or a bid lower into treasuries, that's important to talk about simply what kind of mood the environment is really in. Of course, crude kind of barrels higher, 114 on NYMEX crude here stateside, but you also have to look at the crude at the risk-off picture when it comes to Bitcoin. Of course, we know it tends to be that risk sentiment indicator, and right now it is down 0.8%. But remember, the volatility is usually about 4% in one direction or the other. So an 0.8% move to the downside, it's not that volatile, Anna, but for now it does seem like we're heading for a risk-off day.
Yeah, and here in Europe, Kriti, I'm afraid I've got nothing inspiring to tell you to give you much direction, because we're pretty grey across this map, not even slightly green or slightly red, just grey. We are either side of the flat line on the German market, the French market and the UK market right now. And we're kind of evenly split in terms of sector performance. A few more sectors moving lower today. Technology is one sector that moves lower today. Energy stocks, though, moving higher. That slightly higher energy price, oil price that Kriti was just talking about, that's pulling some of those oil giants a little higher in the European trading day. One thing that has been anything but grey and anything but boring is the inflation story here in Europe. And we've had those numbers through from the UK earlier. We got Eurozone inflation data just a moment ago. Came in pretty much as expected. It was another reading on some numbers we previously had. This is where we are on the pound, though, today, down by 0.9%. And we got a really high inflation print, at least by recent history, of course, 9%. But it wasn't the 9%, 9.1% that had been tabled by economists. I know that wasn't much of a miss. But yesterday, we spent a lot of our time repricing in hikes from the Bank of England based on the tightness of the labour market. Today, we're just rethinking some of that a little bit, and we see the pound down by 0.9% then. 5-year yield in Russia. I wanted to put this in here because of movement that we've seen, or commentary, plans by the Biden administration to stop the Russians from paying their dollar-denominated debt in dollars. And as a result, we've seen a spike up in yields, as you might expect, on the 5-year horizon, certainly. Siemens Gamesa, this is a renewable energy business over in Spain, up by 11.5%. It's been struggling of late, and they have a big shareholder, which is Siemens Energy. They have decided they may take ownership with a big cash offer and delist this particular business. TUI is a travel business in, straddles kind of the UK and Germany. They owe the German government quite a bit of money since the COVID pandemic. They decided to issue shares to pay back the German government, and as a result, the stock trading down by 11.4%. So this long COVID as demonstrated in the equity markets, Kailey.
Indeed. All right, Anna, so we will continue to keep an eye on those shares throughout the day. And as for what else is ahead on this Wednesday, G7 finance ministers and central bankers will begin a meeting in Bonn, Germany. You'll also have Target reporting its earnings results before the bell here in New York. Interesting to see what kind of inflationary pressures that company is dealing with after the pretty dismal results from Walmart yesterday. And finally, it's one of the busiest voting days of the U.S. 2022 elections, with primaries in Idaho, Kentucky, North Carolina, Oregon, and Pennsylvania. Creedy.
Yeah, Kailey, let's bring it back down to D.C., though. Now to the most hawkish remarks yet by Fed Chair Jerome Powell. He says the Fed will keep raising interest rates until there is, quote, a clear and convincing evidence that inflation is in retreat. Powell spoke during a Wall Street Journal live event yesterday.
Inflation is coming down. That's what we really need to see. So we'll be watching for that. If that involves moving past, broadly understood levels of neutral, we won't hesitate at all to do that. We won't. And honestly, we will go until we feel like we're at a place where we can say, yes, financial conditions are in an appropriate place. We see inflation coming down.
Let's get more with Bloomberg's Danny Berger. Danny, how significant were Powell's comments, or did we kind of already know this when it comes to the market impact?
Yeah, we knew that he was hawkish. It's not surprising that he continued that hawkish message. But one of the things I found interesting was his real endorsement of the market pricing in that hawkishness. He mentioned that the two-year yield, that's been a pretty good indicator of where policy direction is going. And on his comments, we saw the two-year yields rise about 13 basis points yesterday. So perhaps the front end of the curve isn't all hawked up. He also talked about the fact that they're not just hitting and holding. They're not going to wait around to see whether some of the supply side constraints start to ease up. They're going to do what they can, and that means demand. That's why it's not surprising when Jay Powell was asked, are you concerned about the turmoil in the markets? He said, no, look, it's orderly, and it all goes towards this goal of tightening financial conditions. And so financial conditions, yes, they have been tightening. They still perhaps have a way to go to meet Powell's target. But I think this terminal, and for our radio listening audience, it's the Bloomberg U.S. Financial Conditions Index, is one you really got to pull up every day, because this sets the backdrop for the current policy background.
And Danny, here in Europe, we've had UK inflation data. We've had the Eurozone too, but the UK one really moving markets. The last time we had inflation this high, Danny Berger, I was 8 years old. Don't remember how that felt too much, but I'm certainly experiencing this bout of inflation. 9% now, the UK number, and yet the pound falls.
I probably shouldn't tell you where I was at that moment, because I may or may not have been alive. However, yes, 9%, 5 times higher than the Bank of England's target. And this puts them in a really difficult position, because just yesterday we had this really tight labor market data, the lowest unemployment in near half a century. So it means that they just have to really do more. They have to act more forcefully in order to create some slack in this economy, given these inflation numbers, given the unemployment numbers. But it's also interesting that given all of that, the market reaction today was one of sending the pound weaker. It was also one of pricing out rate hikes out of the market. The pound down nearly 1% versus the U.S. dollar. And it kind of just shows the market's disbelief that the Bank of England can handle this and get the economy under control. This is a market trading like it's preparing for stagflation.
Danny, thanks very much. Bloomberg's Danny Berger with the latest there on the broad market thinking and the UK story. Now on to geopolitics. Sweden and Finland submitted their applications to join NATO earlier today, marking the start of a formal process that would fortify Europe's defences and make it more secure in the event of Russian threats to the region. NATO Secretary General Jens Stoltenberg spoke earlier.
I warmly welcome the requests by Finland and Sweden to join NATO. You are our closest partners, and your membership in NATO would increase our shared security.
Bloomberg's NATO reporter Natalia Drozdiak joins us now from Brussels. Natalia, walk us through the latest then. What is happening now that Sweden and Finland submitted their bids?
So the next step in this long process is for representatives of NATO member states to formally accept the application so the countries can start accession talks. Ambassadors are meeting at the moment, but it's unclear whether there will be such a statement today since all 30 have to agree. And this had always been seen as a quick formality that would be agreed very swiftly. But now that Turkey's voiced last-minute concerns, it's unclear if and how much that will be delayed.
Natalia, I'm glad you brought up Turkey, but can you explain to our audience why Turkey is blocking this and the likelihood that they'll succeed?
Well, in the run-up to these expected bids, the focus had always been on Russia's reaction, and allies had said everyone would be on board. Now, Turkey in recent days said Sweden and Finland were supporting Kurdish militants viewed as terrorists, and said it was unacceptable that the countries have restrictions in place on weapons exports to Turkey. NATO officials have tried to play down the issue, saying they were confident it would be resolved, given how important it would be to have the two in their alliance. But the concern is also if they block, it would be a major victory for Putin, who's been calling against further NATO enlargement. One thing to remember is even if there is a statement today and Turkey allows the process to start, they could always block it down the line.
Natalia Drozdiak in Brussels, thank you as always for joining us. From Brussels, let's go to D.C. The U.S. preparing a military aid package for India as it looks to deepen security ties and reduce New Delhi's dependence on Russian arms. Bloomberg sources say the package could include weapons financing of as much as $500 million. Meanwhile, the Biden administration is set to bring Russia closer to the brink of default. Bloomberg's learned the Treasury Department will move to fully block Moscow's ability to pay U.S. bondholders as soon as next week. Anne-Marie Hordern, Bloomberg Washington correspondent, joins us now from D.C. Anne-Marie, so much to digest here. Give us the latest from the Capitol.
Yeah, well, this is a Bloomberg scoop, and if Treasury does go ahead and really not allow this a waiver to continue and allow it to elapse, it brings Russia potentially closer in this debt saga to actually defaulting on its debt. Now, there is someone in the Treasury who says they haven't yet made a final decision. There was a lot of debate about whether or not you continue to allow Russia to draw down their money and allow these debt payments, but obviously also if you push them into default, that is going to be catastrophic for the Russian economy. The finance minister over in Russia, though, maintains that they could still pay off their debts, but by doing so using rubles. So there does seem to be a little bit of, question marks. What also counts a default? Because someone is willing to pay, but they aren't able to. But what we do know is that the Treasury is expected to really let this temporary exemption lapse, this carve out, and that means that it's going to be much more complicated for Russia when it comes to paying their debts.
Anne-Marie, meanwhile, with a focus on domestic politics, today is, of course, Wednesday, the day after a big primary Tuesday in which we saw primaries in a number of states, including Pennsylvania, where it's too close to call between Oz and McCormick in that Republican primary. What are we learning about the power or lack thereof of a Trump endorsement?
It's a great question, because if you look at the map, and there's a ton of primaries last night, Idaho, Oregon, Kentucky, North Carolina, but Pennsylvania is really where it's become very dramatic. We don't know yet about Trump's hold in Pennsylvania, but if you look across the map, you could see that potentially some of his grip is wavering. Some of his candidates won and some others did not. In Pennsylvania, though, it's been really a tough race for weeks, and it became at the last minute a three-way heat. Now it is squarely very close, razor thin, between Bridgewater Associates CEO, former hedge fund manager David McCormick, and Mehmet Oz, which many of us grew up knowing as Dr. Oz. Of course, Dr. Oz is the one that is backed by President Trump, but interestingly, if you look at the makeup of David McCormick's team, it's a lot of ex-Trump employees. So what we do know now is that it's so razor thin. Both these candidates did come out and say it is too close to call at the moment. We're going to have to give it some time. But this is a really important race. People are not just focused on Pennsylvania because the drama behind it and some of the celebrity names, but because what analysts are saying is that Democrats are poised to lose the House, right? And this is potentially a moment. This seat would be replacing a senator seat from a Republican senator, Pat Toomey. Potentially, Democrats think they can maintain control of the Senate. This could be one of the key seats. We still need to wait for these results, but clearly you can see very different ideologies of the Republican Party have a razor, and it's razor thin right now.
Indeed, and November is drawing ever closer. Thank you so much to Bloomberg's Anne-Marie Hordern in Washington for us. Now let's get back to the markets and take a look at one company story in particular that has caught all of our attention in recent weeks, and that would be Twitter, whose board says it plans to enforce Elon Musk's $44 billion bid. They're trying to inject some clarity into the situation as traders bet on Musk walking away from or renegotiating the deal. We spoke to Arjuna Capital's Natasha Lamb in Boston yesterday. Just take a listen to her take on the matter.
I think Twitter has had so many challenges over the years, which is why you've seen, CEOs come and go, move around, why you're seeing what's happening with Elon Musk right now. Unfortunately right now, I feel like Elon Musk is like a cat playing with a ball of string.
Absolutely love that simile. Now let's take a look at how Twitter is performing in pre-market trading, because it continues to trade substantially below Elon Musk's offer price of $54.20 a share. Right now, trading around $38 a share. That's about 30% below that. It's lower by about 0.3% this morning. Another stock to keep an eye on is one of the big movers of yesterday. That would be Walmart. After it cut its profit forecast due to the inflationary pressures it is facing, the stock had its worst day since 1999 in the Tuesday session. On this Wednesday morning, no rebound really to be seen. That stock lower by about 0.2%. And it is a big plunge to the downside for Doximity. This is an online healthcare platform. It reported after the bell yesterday both its quarterly results and forecast missed expectations. You have a number of analysts cutting their price targets as a result. That stock down a whopping 17% before the bell, Anna.
And Kailey, coming up on this program, then we'll talk about these markets with Geoffrey Yu joins us, BNY Mellon Senior EMEA Markets Strategist. What does he make of the inflation pressures, the latest from the Fed? And talking of which, Charles Evans adding to the hawkish tone. Catch our exclusive interview with the Chicago Fed president at 9:30 a.m. New York time. Plus, the last of Lehman Brothers. In today's Big Take story, we take a look at the people attending to the bank's last remains ahead of its final court cases. Just type NI Big Take into your Bloomberg terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta with Kailey Leinz in New York and Anna Edwards in London. Matt Miller is off today. I have a little bit of a depressing chart, but I think it really feeds into the market narrative right now. We're looking at the Fed Misery Index hitting a 30-year high. Essentially, it combines inflation and unemployment. And you can see for our TV audience, for our radio audience, stick with you, it's really at the highest going all the way back to really the late 80s. So this is really important when we're talking about the comments we heard from Chairman Powell yesterday at, of course, that Wall Street Journal event, saying he really wants to tackle inflation and tackle inflation hard. Let's bring in Justina Lee, our Bloomberg Markets reporter, to talk about what this actually means for the markets. Justina, does the market care? Didn't we already know this?
Yeah, that's a good point. But I think even by Fed's recent standards, I mean, yesterday's comments were pretty hawkish. And I think the takeaway here is that Jay Powell really prioritizes fighting inflation right now, even if that means hurting the economy in the short run. So I think for a lot of bond investors that are asking themselves, haven't we priced in enough bond rate hikes already? I think the answer there is if we don't see the CPI coming down convincingly, then maybe the answer is no.
And where does this take us then in terms of slowing down the U.S. economy, Justina? Because there seems to be an admission that, yes, they do want to slow things a little bit. That's the point of what they're doing with financial conditions, of course. But at the same time, they see that they can land this. They think they can land this okay. I spoke to one guest this morning who says he doesn't see conditions for a recession in the high-yield credit market, for example. That's where he was looking. What is the view out there about whether they are creating conditions for a recession right now?
Yeah, it's definitely true that I think for now, most market participants don't really see signs of a recession. I mean, we had pretty decent U.S. data yesterday. Retail sales and factory production both beat estimates. But I think the concerns there are a little bit more medium term. I mean, historically, we know that when the Fed hikes rate, pretty rapidly, it's quite hard to avoid a recession. And so we kind of have to see whether this time will be the exception.
Yeah, quite robust retail sales yesterday, despite those savings being depleted. Justina, thank you very much. Bloomberg's Justina Lee with us on the markets. And for more market analysis, you can check out the Markets Live blog, MLIV Go. That is the function to use on your terminal. This is Bloomberg.
Welcome back to Bloomberg Surveillance Early Edition, now keeping you up to date with news from around the world with the first word. New COVID outbreaks in China raise the risk of more disruptive restrictions. Beijing reported an increase in infections on Tuesday. A cluster is also ballooning in the Sichuan province. All of this is slowly happening as Shanghai slowly emerges from a 6-week lockdown. The European Union is set to unveil a number of measures aimed at reducing dependence on Russian energy. The $205 billion plan will focus on cutting red tape for wind and solar farms. The goal is for renewables to make up an increased target of 45% of its energy needs by 2030. Goldman Sachs and JPMorgan will earn a combined $133 million in fees for advising Twitter on its $44 billion sale to Elon Musk. That's if the deal actually goes through. According to a filing, Twitter agreed to pay Goldman $80 million, while JPMorgan would get $53 million, most of which is payable once the deal closes. Meanwhile, shareholders dealt a rare defeat to JPMorgan's billionaire CEO, Jamie Dimon. Only 31% of them backed the pay packages for Dimon and other company leaders. The vote is non-binding, but the bank says it takes shareholder feedback very seriously. Several months ago, JPMorgan's board gave Dimon lucrative incentives to stay on for a number of years. Coming up, we'll get back to the markets, talk about UK inflation, Jerome Powell's comments yesterday, all of it with Geoffrey Yu, BNY Mellon Senior EMEA Market Strategist. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Jerome Powell's most hawkish tone yet. The Fed chair vows to keep raising interest rates till inflation is in retreat. Powell told a Wall Street Journal live event the economy is strong enough to withstand tightening. UK inflation hits a 40-year high. Consumer prices saw 9%, putting pressure on the government and the Bank of England to take action. A big chunk of the increase came from a rise in energy prices. And Sweden and Finland make it official. They've now formally applied for membership of NATO. But they still have to overcome opposition from Turkey's President Erdogan. Erdogan alleges both countries support Kurdish militants that Turkey sees as terrorists. I'm Anna Edwards in London with Chrissy Gupta and Kailey Leinz in New York. Matt Miller is off today. And back to the markets, Chrissy. European equity markets losing their footing just a little bit. US futures looking a little bit weaker. We've heard it all before, in a sense, from Jerome Powell, and yet that sentiment weighs on market appetite a little.
It certainly does weigh on it, but I have to ask how much of the moves you're seeing, this real risk-off tone, actually has to do with the fundamental drivers as opposed to perhaps a technical move, essentially a rebound, or I should say a pairing of the gains that you saw from yesterday's rebound, 2% gains in the S&P 500. It's only natural when you see a kind of fast and furious rally to see a little bit of a pullback. And I wonder if we're getting a little bit of a whiff of that in futures, only down 0.4%. And I say only with a grain of salt simply because in the volatility we've seen the last weeks and months, futures trading has been a little bit more to the downside or to the upside than just 0.4%. So we have to keep our eye on that. But if you look cross asset, you can see a similar tone. The 10-year yield down 2 basis points, but it's the fact that the treasuries are actually getting a bid that kind of creates or supports that risk-off tone. You see a similar story with Bitcoin down 0.9%. The only outlier here is, of course, oil at a 114 handle, but we know that commodity story is ongoing, so we can't necessarily fold it into that overall risk on or risk off picture for that matter.
All right, Creedy, and I'm not sure how much you can fold into anything in the macro picture in terms of what's happening between Elon Musk and Twitter, except that prices for big technology companies in general are much lower. So maybe he's questioning whether he really wants to pay $54.20 a share for that company, because he seems to be throwing as much cold water as he can on the idea that this deal is going through, at least in the near term. It's really difficult to follow the headlines, and there is a question of whether Elon Musk even really wants to buy this company or if he's looking for a way out. Obviously, we are still awaiting the answer to that question. But as we do so, and as Twitter says they are committed to that $44 billion deal, we are still seeing the shares, while higher by about 0.5% in early hours, trading far below that offer price, right now at $38.50 a share, so almost 30% below that. Also, I would point out that Tesla, Elon Musk's other company, is moving lower to the tune of about 1%. You did have a price target cut over at Piper Sandler overnight due to the headwinds from China. Now a $1,035 price target on that stock is trading right around $7.54 in early hours this morning. You have another EV maker, Rivian, lower by about 1.6%. And finally, I also wanted to point to Coinbase because, Anna, it's only down about 2% in early hours this morning, but after a 13% move higher yesterday, that was the 9th trading day in a row. The stock has moved to the upper downside by at least 9%. Really remarkable swings for a $15 billion market cap company.
Volatility in crypto. Who'd have thought it? Let's have a look at where we are in Europe then, Kailey. We've got European equity markets retreating just a little bit, as we were just saying there with Chrissy, moving lower here in Europe, down 0.1%. Energy stocks, though, doing well. Chrissy was showing us the oil price at the moment, and that is benefiting some of those energy majors or oil majors here in Europe. We have some technology stocks moving a little bit lower. Also moving lower, the pound down by 0.8%. Yesterday, we saw a gain of more than 1%, and we were pricing in more rate hikes from the Bank of England because of the tight labour market. market. Today, we're removing some of that pricing in of hikes from the Bank of England, not because we got a low print on inflation. We got 9% inflation here in the UK, but it wasn't above estimates from economists, and so perhaps that is something of a corner we are turning. Siemens Gamesa renewables energy company, this is up by more than 9% over in Spain. One of their big shareholders, that is Siemens Energy, they are considering putting in a cash offer and taking this company private. TUI is an interesting one, down by just over 10%. This is a travel and leisure stock, a vacation business based in Germany and also with operations in London as well. And the stock is weaker because they're raising money so they can pay back the German government that lent them so much money so that they could get through the COVID pandemic. It just shows, Chrissy, that we are not entirely done with that story yet.
Not entirely done with that story, and it's really interesting how this is actually folding into the markets broadly, because sure, we see this risk-off tone perhaps in today's trading, and we have the Federal Reserve in the background, but I also have to ask about the currency picture and how much of that COVID story and the strength of the economy and the exposure to the COVID story, whether it's zero lockdowns in China or here in the States, and just in terms of how much of that is actually increasing stateside, feeds into the currency picture. There is no better person to ask about that than Geoffrey Yu, BNY Mellon Senior EMEA Market Strategist. He joins us now. We thank you so much for joining us. Let's start there.
Thank you.
Dollar strength seems to be a major theme of the story, and a lot of people are saying this, of course, in response to a very hawkish Federal Reserve. But I also wonder how much of this is simply a function of capital flows. After all, you can use the dollar for anything: oil, sovereign debt, U.S. stocks, name your pick.
Sure, yeah, it really is a combination of both. If we look at risk aversion, then people want to own the most liquid safety asset, and ultimately people will gravitate towards US cash. You know, I'm even cautious about saying US treasuries anymore because if the curve steepens, then your total return may suffer there. So really, it's just front-end US and US cash. There's demand there. But at the same time, we do think that the Fed is leading the way in tightening global financial conditions. You know, real rates are still rising in the US, and I don't think we've seen an end to that yet.
Good morning to you, Geoffrey. Very nice to see you. There seem to be a lot of things that are like the 80s right now. I mean, a lot's like the 70s, some people tell us. But things like the 80s, we've got UK inflation like it's 1982. We've got a talk of plaza accords like it's the 1980s as well. And this links into what Kriti was saying about strong dollar. Right. We see strong dollar this morning. And there is this chatter in the markets as to whether we would see cooperation amongst G7 or some grouping to try and weaken the dollar. Is that something you anticipate?
Absolutely not going to happen. I want to be very clear on this here. Asian central bankers, they have very, very long memories, and the people in charge of these central banks right now, they will say that Japan's lost decades perhaps was a direct consequence of the Plaza and Louvre Accords all those decades ago. So this is absolutely something they will not risk.
OK, and not in any other fora then? Because, I mean, maybe, you know, France, the UK, well, the Eurozone, the UK, others could come together and do something.
So it's interesting to mention here because the last time there was sort of, the first time Euro intervention took place was during the first years of the Euro. You know, back then, that was seen as undervaluation by the ECB. So they did come in to support the Euro to some extent. But again, that was a function of absolute and relative growth expectations. If the US continues to power ahead in growth and policy powers ahead, it is what it is.
All right, Jeff, so if the ECB hikes in July, what will it mean for the euro, considering in theory that would help, yet it looks like an ECB that's going to be hiking into weakness?
So July has been well telegraphed, and we are quite surprised that not only in euro dollar, but euro on the crosses, you know, there's really been lack of movement right now. So I think there really is this underlying concern that even if rates go up in the Eurozone, it's still quite some distance compared to where the Fed is. And secondly, as you say, hiking into weakness, and there are lots of risks, the euro-specific risks right now. So I think markets are saying, yes, the ECB are hiking, but plenty of other central banks are hiking right now. I'm not just going to take my chances with the Eurozone, so putting money to work elsewhere in the US, Latin America, and EM. Yeah.
Well, and across the world, in Europe and the US as well, you're starting to see some concern about the weakness that central banks are hiking into, reflected in the bond market, where we've seen yields coming off of their highs of the year. Are we moving back into a world where bonds actually do act as a hedge and your 60-40 portfolio is going to work again?
I think we will start to gravitate towards that, but I'm not ready to call a trend-wise rotation back into bonds yet. I don't think we get to that point until the market really fully prices in what the Fed could do. I'm not saying they will do, but until we start to think about 4% Fed funds rates, you know, where terminal rates are, and really just backing up what Chairman Powell said, restrictive rates. there will still be steepening risk. So bonds, I think there is some coming back. Take the UK, for example. If I had to pick one central bank in G10 at risk of a pause, then probably it's going to be the BOE. They have a longer maturity profile in the gilt market, so I think that's where you could see a case for greater hedging via gilt. But across the board, until the Fed calls time on expectations, I don't think we're there yet.
Jeff, I'm so glad you brought up the BOE because, of course, we did get data here that inflation is a 40-year high at 9% in the UK. But I'm curious what that means for the cable rate. We're looking at 123, 124 now. Do we hit 120 in the next couple of months?
So to be clear, we're still quite negative on the UK economy in terms of real income growth. That's something that BOE has flagged. 120, if we hit there, I think those are good levels to actually come back. So valuations, as much as we're cautious on the UK economy, valuations in cable in particular are more attractive right now. So I think buyers may come back in.
OK, so buyers may come back in. But how weak does the UK story get, do you think? I mean, inflation running at 9% right now. Bloomberg Economics says it doesn't dip below 8% this year. The Bank of England says it could go to 10% in October when we get another review of the energy price cap. So that's the inflation side of things. When does that inflation start to sort of eat itself and really put a brake on the UK economy?
I think it's already putting a brake on the UK economy already. If you look at the labour market data yesterday, yes, it was strong. Is it shooting out the lights? Are we going to get double-digit rate growth, wage growth to push real wages higher? That's not going to happen. There's only downside risk to the BOE's current forecasts for real income. And considering how much the UK economy depends on spending, around 70% or so, then it's really going to be a problem. So, that's why I went back earlier. If there's one central bank, major central bank, that could pause in the near term, it could be the BOE.
Well, and of course, there's a number of central banks in Asia that aren't in fact hiking at all, so they don't need to pause. They're easing, including the PBOC in China. Jeff, how are you viewing the China story right now? And when Beijing says they want to support the markets and the economy, can they be believed?
Well, right now, I think markets are really taking this with caution because you can say, launch projects and say activity is going to happen, but until COVID policies, until we get to the other side of that, markets just can say if people can't do much, then you can put money to work, you can deploy credit, but ultimately activity on the ground is going to be soft. So that's why we're not seeing the CNY strengthen aggressively. We're not seeing Asia risk being lifted as well. And one final issue there is if China eases, if the PBOC cuts rates, or dollar CNY continues to strengthen, it's going to really restrict room for maneuver for other central banks as well.
Jeff, thanks so much. Thanks for spending time with us. Geoffrey Yu of BNY Mellon. Coming up on the programme, Tencent's revenue missing estimates this morning. What do these results mean for Chinese tech companies from here? We'll get analysis. This has been a big talking point, of course, over in China. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, Columbia Sportswear CEO Tim Boyle. That's at 10:30 a.m. in New York, 3:30 p.m. in London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Kriti Gupta in New York and Anna Edwards in London. Well, of course, now we have to turn to China's largest social media and gaming giant, Tencent, posting its slowest revenue gain on record. That's after lockdowns and a sweeping government crackdown wiped out growth. Remember, this is the slowest revenue growth this company has seen since it went public in 2004, really seeing the impact of not just the crackdown on technology, but also the slowing of the Chinese economy in general due to COVID zero policy, Kriti. And the question is, now that Tencent's growth has slowed to this extent, what will make it come back? What do you need to see out of Beijing policy-wise?
And this is so important when we're talking about just the amount of pain that has been seen in a lot of these tech companies, essentially, and a lot of the Chinese stocks, I'll say broadly, investors basically pulling out because of that regulatory scrutiny. But how much of a drawdown, I think an 80% drawdown from its peak, is enough to buy the dip, actually? So, Anna, this is going to be fascinating when it comes to how low is super attractive.
Yeah, absolutely. How far through the crackdown on tech names are we? And what difference does lockdown make then, Kailey? Because in other parts of the world, of course, big tech has benefited from that kind of environment. But what's the China story?
All right, well, let's get an answer to that question. Bloomberg Opinion tech columnist Tim Kolpin, who's normally based in Taipei, is with us in the New York studio today. Tim, it's great to see you. I believe this is the first time you've been back in New York since before the pandemic hit. So when we look at Tencent, which has seen growth slow now for 7 straight quarters, we're talking the lowest rate since 2004. What do you need to see from Beijing to bring that back?
Well, interesting, we've been seeing some of the signs that we'd be wanting to look for from Beijing already the last few days, in fact, the last couple of weeks. Signs coming out of Beijing from the central government is saying, hey, we do actually need to support the platform economy. And there's indications essentially that the crackdown may be over. And so as Tencent reports today, it's just reported about an hour ago, we went through the numbers just now, we have an investor relations call coming up. People will be looking at the numbers less, I think, this time, and looking more at kind of passing the words that come out of executives' mouths. What are they hearing from Beijing? You know, everyone's trying to read the tea leaves here, and so the executives are at the forefront of this problem or challenge are the ones that we want to look at more closely to see what they want to tell us. But they're not going to be too open, they're not going to share too much. They've also still got to keep, Beijing on side. So it'll be very, very interesting to read what they have to say. And I think investors will be kind of putting these numbers behind them and looking forward and kind of guessing, is this the bottom in terms of course, the share price, but in terms of revenue growth and, of course, the crackdown. Maybe things are going to be looking up from here.
I'm glad you hit the share price because that's where I want to go next. This idea that you've seen such a big drawdown already, but has a lot of damage already been done in terms of relationships between China and the rest of the world? Sure, the regulatory scrutiny is easing now, but there is a possibility that it could ramp back up. So how much damage has actually been done?
Yeah, look, a lot of damage has been done in terms of what's been going on within China internally. Not only the crackdown, but of course the crackdown on COVID has been very severe in Shanghai, Shenzhen, now looking at Beijing. So there's definitely a macroeconomic effect with inside China. And it doesn't help if China's relationship with the rest of the world is not as robust as it could have been, say, 5 years ago. But one thing about Tencent, for example, is it's a very internally focused company. And part of their problem, part of their challenge is they don't get a lot of revenue from outside of China. They're trying to push overseas. They're trying to sell their games overseas a lot more. They're kind of having not great success, but there's still that opportunity. It's potential. So if you talk about the bottom, there's always upside to get more overseas revenue. And anything that kind of causes macroeconomic uncertainty is definitely a headwind for someone like Tencent.
Tim, if we're going to see further lockdowns in China, and if that is something that we're going to see as we head towards those important meetings in the fall in terms of Chinese leadership, how will that play for big tech? Because in other parts of the world, we've seen actually some technology businesses do really well during lockdowns as people got stuck at home. How does that play out in China?
Well, you really have to pass every company individually. For example, Tencent is big on gaming and, of course, social. So on the gaming side, if people are sitting down at home, stuck inside, can't go out and about, they may be playing more games. We saw that in the last 2 years in China with Tencent and other games companies. But, of course, if they can't go out to restaurants and advertisers feel there's no point advertising because they're not going to get the revenue from it, then there'll be an advertising impact. Now, at the same time in China, we're seeing an impact on advertising because of new tighter regulations of various types. So that's definitely a problem. But having said that, the government has indicated very, very clearly that macroeconomic growth, GDP growth, is very, very important to Beijing. It's very important for them to push growth, and so they will do whatever they can to juice the economy.
Tim, I think it speaks to this moment we're in where you said people playing games, and I immediately think of Elon Musk and his Twitter account and whatever dance he's doing with this Twitter deal. What is your assessment of what he's actually trying to do here?
Well, I think the chance that this deal doesn't go through at 54.20, it's a non-zero chance. It is possible that it'll fail. And we've got all the advisors on both sides working their butts off to try and get this deal done, putting the documents together, getting Elon Musk's signature on it. They're working very hard to kind of push that chance as close to zero as possible. But what is he exactly playing at? It's really hard to know. My guess, as an opinion columnist, based on everything that he said, everything we've seen, it's really about kind of a negotiating tactic. Maybe he's not too keen on paying 54.20 per share, given what's going on around the world, given the drop in tech shares. He's like, well, why would I pay that when maybe I can get away with paying a little less? So I think we're looking at a bit of bargaining going on.
I wonder how much thought went into 54.20, given what we know the 420 is sort of linked to. But anyway, we'll talk more about this, no doubt, as we move through the saga. Tim Colpin, thank you so much for joining us on set in New York, Bloomberg opinion columnist. Thank you. Coming up on the latest episode of Studio 1.0, Emily Chang speaks exclusively with the Roblox CEO, talking of gaming, and co-founder about the online gaming platform's explosive growth. Catch that tonight at 9:30 p.m. in New York. This is Bloomberg.
Inflation is biting. We see for low income or lower income families really difficult to deal with the rising cost of energy. We also see that for companies that had investments or that were dependent on energy or on grain to a certain extent, the whole value chain has been completely destroyed.
That was Unicredit CEO Andrea Orcel exclusively speaking to Francine Lacqua on Bloomberg's Front Row in his first TV interview since taking the helm. Now we're joined by a very special guest, Tom Keene, co-anchor of Bloomberg Surveillance. He joins us now with his single best chart. Tom, what do you got?
This is a little background story. It's something off the radar of America and, frankly, the Western Hemisphere, and it is Japan. It is the absolute disaster, which is the lack of Japanese economic growth. This is something I've talked over the years to many leading economists about. It's just simply the Japanese malaise, the boom out of the 80s up to 1997, and Japan basically flatlines through the global financial crisis, a very modest recovery, and create a rollover off of COVID. It is stunning how nominal GDP based in yen has gone nowhere for 25 years.
Interesting, and interesting that one of our previous guests, Geoffrey Yu, was linking that to the Plaza Accord back in the 80s, which I know is back as a talking point right now with the strength of the dollar, Tom. Good topics to talk about then with Seth Carpenter, who joins you.
Well, today we've got Seth Carpenter with us with Morgan Stanley, but a lot of other good guests. It's a really nuanced day, Anna, coming up. We start strong with Kit Jukes. We will talk to him about pound sterling and Governor Bailey. And we'll also talk to him about the collapse of Arsenal, which Anna Hahn could care less about.
Is that the Tots, Tom? I can never keep track.
No, the Arsenal's not the Tots.
Okay.
They're like arch rivals, and they play in a derby, except they call it, Kailey, they call it a derby, except it's spelled derby, and I don't understand.
All right, I learn something new every day. Tom Keene, co-anchor of Bloomberg Surveillance.
Anna will
Thank
save
you
us.
so much. Now, something else we're going to learn today is how much results from Target and Lowe's reflect what we saw from Walmart and Home Depot, their big rivals, yesterday. Of course, Walmart dealing with inflationary pressure. It saw its worst day since 1999 yesterday off the back of a cut forecast. But Home Depot looks like demand is still hanging in there, even in the face of higher mortgage rates. So how much will Lowe's benefit from that, and how much could Target face those same inflationary forces, Creedy?
Well, Kailey, speaking of mortgage rates, I'm watching U.S. housing starts, that data coming out at 8:30. Do you start to see that construction boom continue? How much of damage are we going to see with that perhaps decreased demand, Anna?
Yeah, absolutely. Good topics of conversation, of course. I'm going to be watching as the EU drafts a new plan to try and wean the continent off Russian fuels. That's going to be a big focus. Also be aware the Turkish President Erdogan is just currently speaking about his reservations of expanding NATO to allow Finland and Sweden to join. So we'll continue to monitor that story through the hours ahead as well. That is it for the early edition. Surveillance is ahead with Tom, John and Lisa. This is Bloomberg.